All right. Welcome out, ladies and gentlemen, to today's special webinar brought to you by Tackle Trading. This is Coach Tyler. Excited to hang out with you this evening. The topic for tonight is going to be how to trade the naked put strategy. So we've got an hour that we're going to be chatting together here. I've got a lot of angles at which I want to kind of explain the naked put. And whether you've never traded this option strategy before, or whether you're an expert and veteran trader in using naked puts, I suspect you will get a lot out of this discussion. Okay, so I'm going to pull open the chat window section here of YouTube. Give me 1 second. I'll make sure I can follow along with the comments. All right, Gino, what's going on? Hello, Dennis. Good to see you both. All right, so if you guys have questions or comments as we go, feel free to utilize the chat window, and I will check in on that as we go. Terry, hello, hello. Patricia, good to see you. All right, and I'm going to try to take good notes here as I go through to keep this nice and organized. If you guys want a copy of the notes, I will be sure to make that available to the team. You can just email team@tackletrading.com to get access to the notes. Okay. Good evening, Ben. Hello, Linda. Okay, so let's rock. Let's rock. So the naked put strategy, I want to explain kind of the characteristics. Let's start with this. Characteristics of the strategy. Okay. So number one, and let me actually back up a step. The structure of this trade. Okay, what we're going to be doing here is we're going to sell a put option. And specifically, we are selling to open a put option. So this isn't a put that you previously bought that you're selling to get out of. This is a put that you haven't previously entered that you're selling to initiate a new position. So we are selling put options. When you look at the name, a naked put, okay, this is also known as a short put. We're selling to open a put. We're shorting a put, we're entering a naked put. Those are all the same strategy, all the same thing, all right? So what do we like about this particular strategy? Like if I don't know, if I'm the naked put and I'm filling out my profile for a dating app, you know, I'm gonna lead with my best foot forward, right? I'm going to highlight my positive attributes and maybe neglect to mention that, you know, I don't know, that I have all these flaws, right? So if we lead with the foot forward here, why do people like naked puts? Why do people like naked puts? Oh, Dennis, that's good. Yes. AKA short put or a put right. Yes, it could also be called that as well. Good catch. Oh, you know what? One other one while we're on here. It could also be called a synthetic cover call. If you wanna add that in. So why do we like naked puts? Number one, you get a profit from time decay. Okay, so this is a strategy that makes money as time passes. As a result, we call it a cash flow strategy. Cash flow strategy. It has a higher probability of profit. Higher probability of profit than long stock or a long call option. Okay, so we're using this to improve our probability of profit. Okay, you can use this, to, let's say it this way, actually, I can get paid to buy the stock at a discount. I can get paid to buy the stock at a discount. That would be another way that people use puts. So fundamentally, I think there's really two ways that you can go about using naked puts. So method one is you could sell puts as a substitute to buying stock. Okay. So you may go out and you may buy Apple. Okay, you may buy Apple and you get all of the upside, you get all of the downside, you're long stock. I may come out and I may sell puts on Apple. Okay, you only bought Apple once and you can hold it for a year or 2 years or 5 years or whatever. When I sell a put, it has an expiration date. And so let's say I sell a 1-month put option. So it gives me exposure. It's a bullish trade. So I have exposure to Apple for the next month, and then the put expires. And so if I'm going to try to replicate being long the stock by selling puts, I've got to do it month after month after month after month. So one of the things we'll do in tonight's webinar is we'll build out some rules for how I could use puts to cash flow a stock in lieu of just buying the stock. Okay, in lieu of just buying the stock. So I'll do a side-by-side comparison of long stock versus selling puts. A second method, I think, is just using it as a trading vehicle, using it as a high probability trading vehicle, a trading strategy. Okay. So I don't necessarily have to be married to the stock for the foreseeable future. I may just say, look, right this month, I think this is a good naked put trade, and I may never trade the stock again. So it could just be one extra strategy I add to my bag of tricks that I pull out from time to time. All right, so when you look at the risk and reward, when we look at the risk and reward, so we're selling to open a put option. One of the things that we need to think about is which put option we sell. So usually we sell, now I prefer to sell 1 to 2 months. So right now we're in August, I'd be selling September monthly options. I think are about 30 days out right now. That would be the month that I'd be looking at here. I think 45 days is a good sweet spot to consider when selling these, because you still get a pretty good rate of time decay, but you're able to go far out of the money if you want. If you sell like a 1 week naked put, you're not able to go that far out of the money. Okay, so I like selling 1 to 2 months myself. And you can sell basically out of the money if you want a higher probability, but a lower profit. If you want to go more aggressive, you could maybe sell at the money. You have a lower probability, but you have a higher profit. So I think most people, when they start out with naked puts, they kind of say, hey, I want to sell far out of the money because I want a really high probability of generating the cash flow, but you don't make as much. And so if you're willing to kind of look at this as a proxy for owning stock, where you just want to consistently sell puts instead of buying stock, I don't mind selling at the money puts myself, or maybe even slightly out of the money to get a higher payday. So we'll do a comparison here in just a minute. But really, that's the name of the game. We're just selling a short-term put on a stock that we are, let me give you the bias here. This is a neutral to bullish trade. If you're familiar with our number scheme at Tackle, 0 would be neutral, +1, mildly bullish. That would kind of be the bias when you consider this trade. If you're aggressively bullish, you probably want to buy a call or buy stock or something. I don't mind if the stock goes up a lot when I sell a put. It doesn't mean you don't make money if the stock goes up a lot. You will be profitable. It just means that you may have wished you did a different strategy, something that would have taken more advantage of it. All right, so let me start with using it as a high probability trading vehicle, and then I'll go through and show you how to consider selling puts as a substitute to buying stock. Okay, so when I'm searching for candidates, okay, one of the things you got to think about is what is the cost of the trade. So let me actually back up a step. When we look at the risk reward characteristics of a naked put, the max reward is what you get paid up front. Okay, it's the premium received. So if you sell a put for 50 cents, that's your max profit. If you sell it for $1, that's your max profit. The risk is the strike price minus the premium received. Okay, so if I sell a 50 strike put and I get $1, my risk would be 49. If I sell a 50 strike put and I get $2, my risk would be 48. If I sell a $50 put and I get $4 of premium, my risk is 46. So you just take that strike and you subtract the premium received to get your risk. And that would be if the stock went to 0, which is unlikely in a month. Okay. The break even for this trade, expiration break even, is the same formula as the risk. So it's the strike price minus the premium received and the probability of profit, pop, if you will, is 1 minus the put delta. So if you sell a 20 delta put, you have an 80% probability of profit. If you sell a 70 delta, or excuse me, a 30 delta put, you'd have a 70% probability of profit. Okay. All right. So those are the numbers. So when you look at method 2 here, candidates, what price range am I going to look at? And actually, I forgot to put the margin requirement. This is what I was trying to get at here. How much are they going to make me put up to sell a put? Assuming you're in a margin account. So that means you're not in an IRA. You're not in a 401k. You're in just a taxable margin account. Your margin requirement is usually about 15% to 20% of the stock price. And so if you sell puts on a really expensive stock, they're going to tie up a fair bit of money. I think most people prefer to look for cheaper stocks, maybe stocks under, I don't know, $50, $60 that are neutral to mildly bullish. Okay, that's how I would look for these. And so let's do that. Let's do that. Let me go to my watch list here. And for my scanning, I mean, I could just look at my watch list, sort it by price, just kind of stick with the stuff that's under 50, $60 and just go from there, right? And I could just pound through these guys one chart at a time until I find a setup that I'm neutral to bullish on. Now, in this example, it doesn't have to be a company that I'm in love with the fundamentals. I'm just looking at selling a put as kind of a short-term trading strategy. So in this instance, I'm less concerned with, hey, are you willing to buy the stock? You're willing to own the company for the foreseeable future. And I'm more concerned with just, hey, are you bullish right now in this cheap stock? Okay. So how about SLV? How about silver? If I look at the chart of SLV, that looks not neutral, but bullish. It's in an uptrend. Okay. It's cheap at $25. And so let's say that I believe over the next month, silver is going to continue to be somewhat bullish. Okay. I think silver is going to continue to be somewhat bullish. So I'm going to sell a put. Okay. I want to sell a put in SLV. So I'm going to come here to the trade tab. And I'm going to go out to September. Now, what delta should I sell? I got a 45 delta, 41, 36, 32, 27, 23. If you want a high probability of profit, like more than 80%, then you'll want to sell a delta around 20 or less. Okay, so if you're going to go with a higher probability of profit, I like that 20 delta kind of as a rule of thumb. So for silver, I've got a 22 strike here. 51 cents is the midpoint. Delta's around 20. Delta's around 20. So I'm going to sell by clicking on the bid price. And that brings up a sell order. It says you want to sell one silver September 22 put. 50 cents. It's defaulting to the bid price. I could increase that to the midpoint. I'm getting paid $51. I'm getting paid $51. In exchange for doing what? Well, let's be clear on this. When you sell a put, okay, when you sell a put, the obligation is you have to buy 100 shares of stock at the strike price, okay, at expiration, or let's just say if assigned, okay? So by selling this put option in silver, and I see some questions coming in, I'll grab those here in just a second. By selling this put in silver, this 22 put, I'm getting paid $51 in exchange for obligating myself to sell, to buy SLV at 22. Now I get to keep that 51 cents. So if I did in fact take this through to assignment and I did buy the stock, it actually wouldn't be 22. It'd be 22 minus what I got paid up front, 50 cents essentially. So my cost would be $21.50. So $21.50 is going to be my break even. 2150 is going to be my cost basis if I'm assigned. 2150 is my maximum loss if silver goes to zero in the next month. And so I like to put that on the chart and then just kind of look and say, well, how do I feel about that bet? Do I feel confident that SLV is going to be at or above 2150, 22 in a month? If the answer is yes, then I like the trade. At least so far. There's a couple other numbers I want to look at. But if you look at this and you say, nah, Tyler, I think silver's going to crater and it's going to be below 22, then this is probably not a trade you want to take right now. Probably not a trade you want to take right now. Okay. Now, if I look at the margin requirement, how much money am I going to have to put up? I know the maximum loss is 2150. Okay. 2150 is my cost basis. That's $2,150 on 100 shares. So if I had to put up the maximum loss and I made $51 on 2150, it's only about a 2.4% return, only about a 2.4% return. It's not that great. It's not exciting to me. Doesn't really get me jazzed to do this. So see, if I were to sell this put and have to tie up 100% of the max risk, it wouldn't be as attractive of a trade. And that is what you have to do if you're in a retirement account. Okay, so it's not really a naked put, it's considered a cash secured put or a cash secured short put if you do this in an IRA account. You can still do it. 2.4% is not terrible over a month, but it's going to be much, much more attractive when you look at in a margin account. So if I hit confirm and send, this paper account is pretending it's a margin account, okay? So it's going to calculate the margin or the collateral I've got to put up as if I was in a margin account. I don't have to put up 2150. See, that's the max loss, 2150. It's only making me put up 220 bucks. So all of a sudden, what would have been a just kind of ROI in a retirement account, now $51 on 220, that's a 23% return. Okay, my ROI is like 10 times better if I can do this in a margin account versus an IRA account. That's not bad. So in Thinkorswim lingo, the buying power effect is the margin requirement, is the collateral, the initial amount of money you have to put up to do the trade. Okay, so they will take that $51 and 220 of your dollars, and they'll hold it aside while you're in this trade. Okay, and then they relinquish that when you get out of the trade. So those are the basic numbers here. What kind of an ROI are you shooting for on a naked put? I would say 10% or more. 23% is fantastic. It's going to depend on what delta you sell. I mean, I sold a 20 delta put, so I got a little more premium than if I had sold a 10 delta put. But, you know, I think a pretty good naked put is a 10% return. If it's a really boring stock like Verizon or a telecom stock or something, a staple stock like Coca-Cola, you're probably not going to find a 10% return on a naked put. Silver right now is volatile. It's got quite a bit of juice in the options, and that's why I'm getting a 23% potential return. Now, it should be noted that the margin requirement may vary depending on A, what broker you're using, B, maybe what country you're in. Okay, Gino mentioned earlier the collateral requirement for Canada. Gino, I think he said 30%. Okay, so I'm an American. Okay, so I'm just speaking of what the numbers are in my account. It can differ. It can differ. Okay, that's something you have to check with the broker and say, hey, what is your formula for calculating margin requirement for a naked put? But you know, I'm using a paper account here in Thinkorswim. You can see the numbers in front of you. For this one, they're at 220. It also may depend on your account size. If you have portfolio margining, which is typically if you have over $100,000 or $125,000 in the account, the collateral formula is a little different. And so there is some variation here. The good thing in this case is even if my margin was double, even if it was 440 bucks, you're still looking at over a 10% return. Okay. So if you have crappy margin requirements, maybe come move to the US. I don't know. It is what it is, but that's what I have on my end. Okay. Okay, so let me advance this one more step, and let's talk about management for a second. So I sell this put. Now, quite frankly, would I sell the put today? I mean, silver got hit pretty hard. Maybe I'd wait until tomorrow, see if it starts to pivot and turn higher. If it's going to keep coming down, it'll just improve the setup. So with timing these, remember, this is a bullish trade. All bullish trades, I'd like the stock to go up after I enter, not down. If I think the stock in question is going to keep pulling back, then I'm not going to enter my trade. Okay, so to the extent that you can, you want to try to optimize your entry with these. There's no sense in me selling this put today for 50 cents if I can sell the same put tomorrow for 75 cents or the next day for $1. Okay, so make no mistake, even though this is a cash flow trade, it is a bullish trade. The better you can get at nailing the bottom, nailing the support level when this thing starts to pivot higher, I think the happier you're going to be. Okay, I think the happier you're going to be. Okay. All right. So what do I do once I'm in? And how do I know how many contracts to do? So if I sell this put on silver, 51 bucks, my max reward's 51. Again, it'll tell you the numbers here. 51's the max profit, and you got quite a bit of risk. How do I manage this thing? How do I manage this thing? Well, let's talk about profit target for a second. Let's talk about profit target. So could I ride to expiration and let the put expire worthless? Ride to expiration, ride for 30 days and let the put expire worthless, assuming it's out of the money. So I could fast forward to September. As long as SLV is above 22, the put will incrementally go from 51 cents to 0. It goes quietly in the night. After expiration, my capital's freed up. I get the 220 bucks back plus the $51 reward. It's mine to keep. Okay. And then maybe I sell another put in silver. I don't know, but you could ride to expiration if you wanted to. For me, I like to exit when I make most of my money. So we could exit, and the way you exit is you buy back the put. You sell it to get in and you buy it back to get out. So I could buy back the put, or in really the best way of saying it is you're buying to close the put. Buy to close the put maybe at 80% of max profit. So maybe I say, look, I'm going to sell the put. I'm going to sell the put for 51 cents. Let's buy it back at 10 cents. Let's buy it back at 5 cents. Let's buy it back when I make most of my money. Because what if that last 5 cents I've got to wait 2 weeks? Maybe it's not worth it. Maybe you just take the money and run. Okay. That'll improve your return on time invested. Try to make your trading more efficient by bailing quicker when you make most of your money. Sometimes making the last few cents requires you to wait really close to expiration. And so basically, like, you can make 80% of the profit relatively quick, and then the last 20% sometimes is really slow coming. And so you may just say, I'm gonna take the 80-90% and bail. So in this example, if I wanted to preset that, I could do a first triggers all order. I could say, okay, I'm going to sell this put for 51 cents and then right click and create an opposite order. And I'll buy it back at a nickel. Limit, good till cancel. Maybe 10 cents. Limit, good till cancel. So then I've got a standing order. If the put ever drops in value to the 5 cents, buy it back and I'm out of here. Okay. So that could be a target. What if I'm wrong? What if I'm wrong? Again, remember the premise. The premise in this example was, I don't necessarily want to own the stock. I'm just treating this as a trade. Okay. Just treating this as a trade. So this is a bullish strategy. What do you do with other bullish strategies? Do you exit if the stock breaks support? Exit if the stock breaks support, right? I mean, if that would make you no longer bullish, why not take off your bullish trade? Now, when I look at silver, there is a pivot low right here, $23. That's a support level. There's a little pivot around 21.50. Now, one thing I'll say is I don't really want to put a tight stop with a naked put because it doesn't make sense. You can't do a high probability trade selling a far out of the money put and then put a stop loss below the prior day's low. I mean, if you're going to put a stop that tight, then do an aggressive trade where you can actually make more money if you're right. So it doesn't really make sense to go for high probability and then suffocate the trade with a tight stop. Okay. So I would say with naked puts in general, if I'm going to use support, it's going to be a looser or lower support level, maybe not even the first support level. Okay. I 100% would not put a stop any higher than 23 at the most. 23 would be the tightest I would go in this case. And I don't really like 23. Okay. So you could pick a support level. You could exit if the stock hits the strike price. Exit if the stock hits the strike price. So in this case, that's 22. So I could say, all right, let's use my strike of 22. If we hit 22 and my put goes in the money, I'm out of here. If we hit 22, my put goes in the money, I'm just going to exit to minimize the loss, So you could do that too. And see, here's the nice thing. If I right click on the order, the entry order, and go to analyze, it'll kick it over to the analyze risk profile page. And then I can see a picture of my trade. And I'm going to talk more about this risk graph here in just a minute, but I just want to show you that if the stock goes down to my strike 22, it's estimating I'd be down about $100, $95. Okay. So if that's my exit plan, it's estimating you'd lose about $95. So if I only want to risk $100 in this trade, I would sell one contract. If I wanted to risk $200, I could sell two contracts. Okay, $300, I could sell three. You get the gist. So you would sell one contract for every 100 shares you're willing, sorry, $100 you're willing to risk. In this case, I'm just going to go with one to keep it simple. So I'm going to right click. Now I'm going to change my advanced order to first triggers OCO. Stands for first triggers one cancels other. Now I can put in two exit orders, one for my target, one for my stop. So I'm going to make this third order a market order to buy back the put, and then go click on the cog wheel and tie it to the stock price. Say if silver gets at or below 22, get me out. Buy back the put at market. Okay. That is how I view naked puts as a trading vehicle. Okay. There's another way that I would manage it if I like the stock and I'm willing to buy it. But this would be like my base rules, not even getting into making adjustments or rolling. This is kind of the base idea with a naked put. Okay. So as I go in, here's your order. There's what it looks like. I'm going to leave that on the screen for a second. There were a couple of questions that came in. We're going to pivot to how I would use these if I want to buy stock here in just a second. But if you have any questions in regards to this particular example or actively trading naked puts, you could throw it in there. Let's see. So Ahmed, when you get out, yes, you could sell another one. So I could take profits on this September naked put in silver and then immediately sell in October. And maybe I do that in a rolling order. The way that I set it up here, I just have a target, get me out of September, and then I would separately go in and enter an October trade. If you wanted to do that in one order, you could. The deltas are as accurate as any number there is. So there's nothing more accurate than delta in projecting what your probability of profit is. Okay. Just keep in mind that the delta kind of assumes that you have you got to use the law of large numbers. If delta says you have an 80% probability of success, it doesn't mean you'll win 8 of 10. It means you'll win 800 of 1,000, right? Or 8,000 of 10,000. The odds will not play out over a small sample size. Just like flipping a coin, it's 50-50. Not if you flip the coin twice, it's not 50-50. It's 50-50 if you flip the coin 1,000 times, 2,000 times, etc. So you have to have a large sample size for the deltas to get closer and closer to what they predict. And I'm glad Tree mentioned the tier 3. I failed to mention this. there are different tiers of trading authority with most brokers. A naked put is a more advanced strategy. It's not the first thing you get permission to do. So if you've just recently started options trading and have what most brokers would call a level 1 trading authority or tier 1, you probably won't have access to this. So consider that your incentive for trying to upgrade the account or get permission to trade the more advanced stuff. Okay. Is there a poor boy's naked put? No, because a regular naked put is already cheap. I mean, so this is costing me $220. If somebody says, hey, I can't afford $220, I'd say, I mean, go get more money, like paper trade until you can build the account. That said, if your question is there a trade like a naked put that is cheaper than a naked put? The answer is bull put spread. Okay. So Ahmad, if you like, yeah, I got you, Ahmad. If you, cause I have an IRA. So if you have either the inability, you can't sell naked puts and you like the strategy, you could use a bull put spread. Okay. If you're in an IRA and you don't want to tie up all the capital, because, so look at this, guys, when I hit confirm and send, I can change the account down here and I can say, what would it be in my paper IRA account? It says, well, the BP would be 2149. All of a sudden it's 2150. You know, my buying power just went way up, right? So what would I do in the IRA account? I would just do a bull put. Yeah, so I just do bull puts if I'm cost sensitive in an IRA. So what I would do, Ahmad, is I'd come in and while I'm selling the SEP 22 put for the 50 cents, I might just come in and buy like the 17 put for 5 cents. And I'm getting 46 cents instead of 50. But so you give up a few cents credit, but you take your risk, like right here in an IRA account, my risk is $450 instead of 2,100. So I would just do a wide bull put in an IRA. Thoughts at buying back at a certain delta? That's a good question, Frank. And by the way, everybody say hello to Coach Frank here joining us this evening. Let's talk about that. So buying back at a certain delta would be if it's going against you. Okay. So think about this for a second. If I sell, let's say I start with a 10 delta, I sell a 10 delta put. Okay. It's way out of the money. Well, I know if we reach the put strike, the delta is now 50. Okay, the delta is now 50. So if typically we're getting out, if the put goes at the money, the delta is 50. So I sold a 10 delta put when the stock was here. Stock goes down, 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 and that put gets closer to at the money, and then the delta is 50. If you say I'm going to get out when the delta's 30, what you're saying is I sold this 10 delta put when the stock was here. And when the stock gets down to here, this put is now closer to the money. It's going to be a 30 delta. That's essentially what you're saying, right? If the stock goes against me, I'm okay with the delta going from 10 to 15, 15 to 25, 25 to 30, and then I'm out of here. What's significant about 30? I don't know. Frank's the one who said 30. It's just kind of random, right? I mean, your odds aren't as good. What I think you have to ask yourself is, which information do you think is more significant? Do you think it would be more significant to say, I'm selling 10 delta puts. If the stock drops enough for the delta to get to 30, I'm out of here? Or do you think it's more significant to look at the chart and say 30 is kind of random? I'm going to use support and resistance. I'm going to let the chart tell me when to get out versus the delta. I personally, Frank, prefer the chart, but some of the rules you could translate into a delta, like you could express exit if the stock hits the strike price as exit if the delta hits 50. It's the same thing. We're just expressing it two different ways. But that's kind of the only one where you know where the delta is going to be if the stock hits the strike. If the stock breaks support, you can guess where the delta is going to be, but why not just go with support as the metric, the threshold to get you out? You know what I mean? So I don't mind using a delta rule. I just typically don't. Okay. All right. What if I want to use the naked put as a substitute to buying stock? What if I want to use the naked put as a substitute to buying stock? I want to draw a picture on this real quick. I think this is interesting. If you look at the risk graph, oh, you know what? I think my this is going to be a little bit tricky for me. If you look at the risk graph of long stock, this is what it looks like. Okay. So for those of you that haven't used a risk graph before, this would be your profit up here. Okay. My tablet is kind of out of whack right now, so forgive me. That would be your loss. So if the stock goes up, this is the amount of my gain, right? All this area underneath the line. And then if the stock goes down, this meant to be red here. This is the amount of my loss. Okay. So you have this 45-degree, let's see, is it this way? It's this way. I don't know, whatever. Anyways, it's 45 degrees. Okay. So you make dollar for dollar as the stock goes up, and then your break even is right where you purchase the stock. Okay. So like this would be silver, me purchasing it at $24. My penmanship is terrible here. I think it's around 24 right now, right? Yeah, it's more like 25. So I could buy silver right now, and 25 bucks is my break even. What does a naked put look like? If you sold a naked put instead of long stock, you would not have the same upside, right? Because we know that a naked put has limited reward. Okay, so the profit line for a naked put would be like this yellow line. Okay, and then if the stock drops a certain amount, it's going to look like this. I just want to point out a couple of things on the naked put versus long stock. Okay, so the white line is stock, the yellow line is a naked put. When does long stock make more money than a naked put? Well, how about if the stock goes up a ton? Okay, like right here, this area would be where you keep making money on stock, but you can't make any more money on the naked put. Okay, so if the market's up a ton, you're gonna be like, I didn't make as much money on the naked put. Okay, this would be where you underperform if you have naked puts. Big up move to the upside here. But look, where typically you would have a loss on stock, that'd be right here, right? Right here, you have loss on stock. If the stock just goes down a little bit or really at all, you're incurring a loss. What I want to look at though is this section right here. Do you guys see this diamond right here? You normally would not have a profit with stock because that's the white line, okay? With a naked put, you do have a profit. So by selling a naked put, what happens is you now like take this white risk graph and it shifts up to the yellow risk graph and over to here. So basically, if the stock goes sideways, I make money in a naked put. If the stock drops a little bit, I make money in the naked put. So I've taken my break even from the current price of the stock and I've shifted it all the way over here. That's why you have a probability of profit that is higher in a naked put. Okay. So month after month after month after month, you may say, hey, I bought stock and I made money in 8 out of the 12 months this year. Well, had you sold puts, you might have made money in 10 out of the 12 months, or maybe 12 out of 12 months. So the months where the stock was sideways or down a little bit, long stock wouldn't have made money, the naked put would have. Okay. And again, for me visually, because I like the picture here, opening up this area is visually what you're doing when you sell the put versus buy the stock. Okay. Now, here's what I find interesting. If I'm trying to make the case that selling puts versus buying stock is interesting, they being the CBOE, they've done research on this. Say, hey, what if instead of buying the S&P 500, we sold naked puts every month? If you just Google CBOE Put Right Index, one of the first search results here is the Put Right Index, PUT is the ticker. And what it does is it explains the methodology behind the index. And if we look here, CBOE S&P 500 Put Right Index, a put right is another name for a short put or a naked put, is an award-winning benchmark index that measures the performance of a hypothetical portfolio that sells S&P 500 index put options against collateralized cash reserves held in a money market account. Okay. So it's selling puts. And it goes all the way back to 1986. And it tells you, hey, if you sold a put every single month, which it explains in the second paragraph, the put strategy is designed to sell a sequence of 1 month at the money puts. It is selling 1 month, 30-day, 50 delta puts. Okay, so this is not sequentially selling 10 delta puts. This is not sequentially selling 30 delta puts. They're going for the jugular. They're selling at the money puts. So you would think if you're going to consistently sell at the money puts on something, you would be bringing in a lot more premium than if you were selling out of the money puts. So if you feel like, I really want to mimic long stock, but have a better probability, but me selling these little dinky puts for 5 cents every month, I just don't have much upside. If you want more upside selling puts, sell a 50 delta put, sell at the money. Okay. So they're selling month to month at the money puts. Okay. And when you go down, I think they've got the chart. Let's go price charts. Let me go 5-year. So you can go back. We don't have to spend too much time on this. This would be an interesting exercise to kind of go back and say, all right, so how's this index done? Has it been growing over time? And the answer should be yes. It should be growing over time as the stock price is growing. Okay. So if I take a look and I say, okay, instead of buying, I could buy 100 shares of a stock. Okay, or I could sell a 1 month at the money put every month and then ride to expiration and close it, win, lose, or draw, and then sell a new 1 month put. Okay, so you're not really allowing assignment on this. You're just taking the loss on the put if it's in the money, and then you're selling a new one. If it's out of the money, you're buying it back for a penny or something and then selling a new one. This, you're going to get an equity curve. Your performance, in other words, is going to more mimic the behavior of stock. Okay. So think about this. Let's take, I'm going to take silver again. Okay. I'm going to take silver again. Silver is at 24.88. Silver's at 24.88. I could come in and buy 100 shares of silver. Okay. It's calling it 25. That's fine. All right, here's the risk graph of long 100 shares of silver. Okay, but if instead I wanted to go the naked put route, I would sell a 25 strike put. So I'm going to go in here. I'm going to go to September. I'll sell the 25 put. I'm getting at $175. Getting $175 selling those puts. Okay, so this would be my risk graph for the naked put. And see, because I sold at the money, I got $175. That's a lot on a $25 stock. So your upside is quite a bit more. For me to make 175 on the stock, we'd have to get up to about 26.76. So if the thing gets above 26.76, I'll probably wish I just bought the stock. Because the naked put will only generate the $175 profit. But see, the cool thing with the naked put is my break even with stock is the current price, 25. My break even on this at the money naked put is almost 23. So it's like, hey, do you want to have a break even on silver around 23? Or do you want to have a break even on silver around 25? See, that $2 or specifically $170.75 buffer gives you a pretty wide range where the stock would generate a loss, but the naked put generates a gain. Okay. And that really is the magic of using the naked put over the stock. Okay. Over the stock. So that to me is a way, if I wanted to build a portfolio where I wanted to embrace the advantages of options in lieu of buying stock. You know, if I had stock 1, stock 2, stock 3, and I owned 100 shares of each, right? How would I turn that into a naked put kind of cash flow strategy? For every 100 shares, I would just instead sell one put. Every month I sell, you know, if this is Exxon, Apple, and Microsoft, I'm just selling one at the money put in Apple, one at the money put in Exxon, one at the money put in Microsoft. Fast forward 30 days, close them, sell another at the money put. Fast forward 30 days, close them, sell another at the money put. If you do it methodically like that, it's a system. And you start to see how it behaves more like this put right index. This, of course, was just on the S&P 500. But you'll start to see how methodically, you know, it goes up over time if prices are stagnant to rising over time. Okay. So, all right, there you go. Got a couple of questions that came in here. A couple of questions. I would note that on this second example of selling the at the money put in lieu of buying stock, you don't really have a stop loss. Right? You're effectively letting it ride. And that's why you don't want to over leverage yourself, because look, if you're comfortable owning 100 shares of silver and having $2,500 in silver and letting it ride, then you're going to be comfortable obligating yourself to buy 100 shares at 23. You just have a couple $100 less risk than long stock. Okay. So selling puts is not more risky than buying stock if you size appropriately. In fact, it's less risky. Again, with 100 shares of silver, my break even is $25. With one naked put on silver, my break even is 23. If my break even is 23 and your break even is 25, I have less risk than you. So this is also an example of using the options market to invest in stocks in a less risky manner. Okay. All right. Final thing I'll mention, and then I'll get into some of those questions here. If I'm going to sell a put, now I talked about selling at the money puts as a substitute to buying stock for the sole reason that I have more upside. It does a better job of generating profits like a stock would, because you got a pretty good credit up front. If you want to try to mimic long stock selling 10 delta puts, you're just not going to have as much upside. Okay. But you could sell out of the money puts if you're willing to buy the stock at a discount. So I will say for this trade management, if you're willing to buy the stock, instead of having a stop loss, you know, you could ride to expiration and allow assignment if the put is in the money. Okay, you'll hear Coach Mark talking a lot about this. If I look at silver and I say, yeah, I'm a willing buyer of silver down around 22, then I could sell one put for every 100 shares I want to buy, sell the put, let it ride. Come back at September expiration. If we're below 22, you'll get your wish. You're going to buy 100 shares of silver at, in this case, 21.50 actually. Okay. So some people that are willing to acquire stock will allow assignment. They won't get out before that. They'll just let it ride to expiration and hope that silver's not at $16 at the end of the month, because in that case, what felt like a gift becomes a curse. You know, buying at 22 seems great when the stock's at 25, but what if when you are forced to buy it at 22, it's sitting at 16? You know, you may be sitting on a pretty big unrealized loss. I would hasten to add that it's still going to be less loss than if you bought the stock now, right? You have less risk. All right. So let me take some of these comments, questions, and then we'll start to wrap up in the next 10 minutes. All right, Matt, off topic here. How do you feel about straddles right now? I'm assuming this is a long straddle, buying a call, buying a put, going bi-directional. Let me omit the right now for a second. How do I feel about long straddles, period? Not in love with the strategy. I think it's very hard to make money buying. Actually, I know it's very hard to make money buying straddles. So in general, it's a tough strategy. How do I feel about it right now? I mean, if you're buying a straddle right now, it's probably not because you think the market's going to go up. It's probably because you think the market's going to go down a lot and you want to maybe hedge. If you look at the way options are priced, they're not cheap right now, based on how much the market's moving. If like, for example, if you look at the VIX is at 22 and a half. So that's how much movement the options market's pricing in, 22 and a half. Do you know how much the S&P volatility is right now? How much is the market actually moving? Because this is what straddles are all about, is you're betting the market's going to move more than expected. Okay. The 20-day historical volatility of the S&P is about 11%. So the market is moving at an 11% volatility right now. Options are pricing in a 22% volatility. And so the market is a lot more, it's a lot, I don't want to say a lot. It's moving, actually I won't say a lot. I just had to change what I said the sentence. It's moving a lot slower than options have baked into their premiums. So you're going to need market volatility to pick up a fair bit to make money on long straddles. I mean, if you're good at nailing when the volatility troughs, which usually occurs at a market top, yeah, maybe. I don't have a good history of being able to do that consistently, so I'm not a huge fan of buying straddles. I think if I were concerned about volatility increasing, that's only going to happen if the market crashes. I prefer like using a bear put spread or out of the money put calendars over a straddle if you're trying to hedge. Okay. All right, Randy, what's going on? Thanks for the question. On a breakout scenario, don't mind capping my return on a sold put because I can still participate on the momentum by buying back the put and recycling the freed up capital to buy the stock. Yeah, I mean, if the stock's gone up, you'll just be buying it at a higher price. You are participating in the breakout to the extent of the put premium, right? So if you sell a put and the stock breaks out, you're going to be participating. If you then buy back the put, lock in the gain, and go ahead and buy stock at that point. For me, Randy, it would just depend on, has the stock already made its move? You know, am I comfortable initiating a new stock position here? So like for example, you take like Lumber Liquidators. Let's say I had a naked put in this 4 days ago. I've made money over the last few days. If I take profits now on my naked put, do I immediately buy stock? I don't know that I like the entry as much anymore. So for me, buying back the put and buying stock don't have to be connected, right? I can manage that naked put. Yes, participate on the breakout. Whether or not I immediately parlay that into buying stock, it depends on if I feel like it's a good setup right now. As far as these notes go, I'm going to give this to Mark. And if you guys want the notes, you can just email team@tactflowtrading.com. Okay. And I'll have him send out the notes for those that requested. Okay. ASDF. Do we have information on how to utilize margin and the benefits or risk of using it? I mean, yeah, I can tell you the next 2 minutes on what, well, I can't give you a super comprehensive answer, but yeah, I'm sure that's a topic that we've covered from time to time. I don't know that I have a blog article off the top of my head that directly addresses it, but basically margin gives you leverage. And so you cannot trade options on leverage. Okay. So when people talk about trading on margin, trading on quote margin, in this context, they're talking about trading stock. Okay, because again, you can't use margin with futures or options. It's just stock, and I guess technically Forex, it's leveraged. I don't know if we consider you're using margin, but in most traders, when they're bringing this up, they're talking about using borrowed money, right? So I have a $5,000 account, and I can buy up to $10,000 of stock, right? My broker will lend me $5,000. They'll charge me interest, but they'll double my buying power in essence. In some cases, they may quadruple it if it's intraday. So what are the pros and cons? Well, let me address that in a second, ASDF. So in the case of trading stock, everything is like double. So you make money twice as fast and you lose money twice as fast. Okay, so it accentuates, anytime you add leverage to the equation, it accentuates your skill level. Okay, it accentuates your existing skill level. Okay, so if you have a really good system and you apply leverage to it, then you'll make money faster. If you've been losing money and you apply leverage to it, you'll lose money even faster, right? So it's not a magic wand or anything. It's just, do you have the inherent skill to make money with a strategy or a system? And if you say, look, all I need right now is I just need a little bit more capital, and I feel like it would, really accelerate my gains because I'm doing really well. I just need a little bit more capital. Okay, maybe I start to use a little bit of margin. But if you're like, man, I'm losing money hand over fist, I think I need to start using margin. It's like, no, you need your head examined, or you're just misunderstanding how to use margin. You're just going to lose money even faster, right? So unless you're consistently making money without margin as a stock trader, I wouldn't think about using it. Okay. As far as options trading goes, when you sell a naked put, if you sell 1 per 100 shares of stock you would have purchased, you are not over leveraging. Okay. And so when you talk about, I've been selling cash secured puts and I'm uncomfortable going more than that because I'm using quote unquote margin. In the options market, when I talk about margin, I'm talking about the collateral required. Unfortunately, we use the term margin in multiple contexts. So you're not using borrowed money. It's just, we call it your margin requirement because that's the amount of money that's required to do the trade. So bottom line here, even in a margin account, you can still just sell 1 put for every 100 shares you're willing to buy. And even though that's not technically a cash secured put because you're not tying up all the money, tie up part of the money and then just make sure you don't go crazy and sell 2 or 3 or 4 puts for every 100 shares you wanted. So you're in control of that. Okay, you're in control of that. The broker charges interest like anybody charges interest. It's not like they say, we'll charge you interest once a month. So if you borrow money for 29 days, we won't charge you interest because you didn't borrow the money for more than, a month. So they charge you interest from day one. Just like if you borrowed money from a bank, right? The interest rate is annualized. So if they say we're charging you 5% interest and you borrow $100,000, they're charging you 5% of that, which is $5,000 over 1 year. And so if you had it, 1/5 of the year, it'd be 1%, 2/5 would be 2%, 3/5. Anyways, so the number is annualized, but it doesn't mean you're paying 5% every night. You know what I mean? So, all right. Last couple things on the naked put, then I'm going to let you guys bounce. I like naked puts on stocks that are fundamentally sound. I think there's less risk. I like naked puts on cheap stocks. I like naked puts on ETFs as well. So if you want to get into the naked put game and you want to ease into it and do it on something that's a little less risky, I would start with ETFs. Okay. Silver is an ETF. Now it's behaving a little bit more wild these days, but the upside to that is volatility is a lot higher. So you get paid a lot more. If you were trying to sell puts back in, last couple of years in silver, it's been pretty boring. So you've gotten some excitement there, but I really like selling puts on ETFs. Okay. Really like selling puts on ETFs. You don't get paid as much sometimes, particularly if it's a boring ETF, but you're not going to get your clock cleaned either. So I think it's a good way of venturing into that field. And yeah, I would just sort the watch list by price, and the cheaper priced ones typically are going to be those that I'm more interested in. Okay. So from our watch list this week, from the scouting reports, there were quite a few cheaper stocks on there that could have been fair game for a naked put. Halliburton was one. That's a $16 stock. Okay. That's cheap enough for naked puts. Nucor, $45 stock. That's cheap enough for naked puts. MGM, $20 stock. That's cheap enough for naked puts. Nike at $109, maybe not the best for a naked put, but quite honestly, it depends on how large your account is. If you've got a larger account size, you may not mind tying up as much capital. Okay. So the upper price limit is really a personal preference. All right. Okay. Thanks for hanging out, guys. Hopefully that gave you a good little model to follow with selling puts. We write it and talk about these a lot. I've written a lot of blogs over in the options theory blog at Tackle, so feel free to check that out. Once again, I'll save these notes. If you want them, just email team@tackletrading.com and we'll get that sent to you. All right. Thanks, guys. We'll see you next time.